Master these three concepts to trade profitably. Hello guys, my name is Gislen and this is the Forex Hybrid. In this video today, I'll be showing you step by step how to overcome analysis paralysis by sticking to one time frame and identifying valid trade opportunities with maximum efficiency and high win rate. So kindly subscribe, join my free Telegram for free setups and updates, link in the description below. Let's go. So starting off, the first concept is trend direction. We are going to trade in the direction of the trend. So to do that, we are going to have to analyze the charts and conclude where the market is heading. There are three major trends in this market. You have the uptrend, consolidation, and the downtrend. Example of an uptrend is as follows. Now, if we look at the chart on the screen, you are going to see the three major trends, just like I earlier mentioned. We have the uptrend here, and I think it's dark orange or something. Then we have the consolidation in green and the downtrend in pink. Now, let's break down the uptrend first. The uptrend is a market consisted of higher highs and higher lows. This is the high, this is the low, this is the high, this is the low. You feel me? So, in this market condition, it is preferable we take buys. Buying in this market condition is safer, and it is, let me say, it is better and it's more reasonable. Why? Because the majority of the market is trending upwards. So you taking a sell trade is not reasonable unless you're a short-term scalper. Okay, now let's get into it. So impulse refers to the push up in an uptrend. All right, so if the market is in an uptrend and it's pushing up, that's impulse. If it's pushing down in an uptrend, then it's a pullback, it's a retracement. This is when the market is coming back to mitigate orders here or filling imbalances or pick up more orders or whatever you can, whatever your analysis are. So this is an uptrend. This is a pull. An impulsive move is the move. An impulsive move is a move in the direction of the market. Then a pullback is the move contrary to the direction of the market. All right. So now here, let's move on to consolidation. Consolidation, in other words, you can still call it a ranging market, is the same thing. So when the market is consolidating, usually it forms highs and lows that are relatively equal to each other. So the market does not really have like a clear direction or, a clear direction where you can take your trade to. So it is advisable to stay out of a market condition such as this one. Okay, because you can enter a buy here and the market is pulling back. You enter a sell. It's just confusing overall. So staying out is very, very reasonable. It's safer that way. But if you're a short-term scalper and you're somebody who knows exactly what you're doing, then you can maybe, go in there and try your luck. But it's risky. All right, so let's move on to the downtrend, which is the one in pink right here. Now, the downtrend is clear, is the opposite of the uptrend. So the downtrend is when the market is trending downwards, forming lower highs and lower lows. This is a lower high, this is a lower low, this is a lower high, this is a lower low. You feel me? So it's going to continue doing this consecutively till it meets its end. Now, this downtrend here, the impulsive move on this downtrend is a move down. All right, so the push in the direction of the market is impulse, and the push contrary to the direction of the market is a pullback. The pullback are normally weaker. They always have smaller candles. They are weaker generally, but the impulse now is like consisted of heavy candles and there's a lot of volume being traded in that direction. So trade in the direction of the impulse, not the pullback. Okay, yes. So we've already broken down trends. I believe you should understand this by now. Now on this pullback here, this is usually the area where we look to enter our trades, because a trend like this, a market like this that is falling, or these impulsive candles or this impulsive move, you don't know where it's going to end, or you don't know when it's going to start reversing. So let's say this market is pushing down here impulsively to the downside, and like, oh, okay, it's going down, let me sell. And immediately you sell. The market now pushes and starts retracing back and hit your stop loss. It's really going to mess up your work. Okay, so it is preferable you wait when the impulse is over, when it retraces back. When it's retracing, it's gathering momentum. It's putting to, it's accumulating momentum, so that it's going to use it now to propel down. It's going to continue down without all that volume that that's gathered. So when it's retracing, it's taking a break, it's resting, it gather its strength. You feel me? So after that, it's going to push down with a lot of volume. So you should be on that trade at that time. You feel me? So entering at the right time is very, very, very crucial in a game like this one. All right, but we're going to get in depth with that. So this is an example of an uptrend. Now let's break down this chart. Let's dissect this chart top down. All right, now looking at this chart, I don't think anybody should tell you otherwise. This is a clear trend. You can see that at one point the market was here and now the market is up here. This is the value. At one point the price was 2,310. at this level here, the price is 2,400. So there's an increase in price. So the market is trending upwards. It's clear, right? All right. Now, with that common sense out of the way, let's look at the charts actually and how to break down charts, right? So we look at charts in highs and lows. We have a low, we have a high, we have a low, high. This is a consolidation, just like what I was telling you guys. There are three phases in the market: uptrend, consolidation, downtrend, right? So the market now is consolidating here. Then it broke out of it, continued an uptrend. So when this happens, this is a break of structure. We have a low, we have a lower high, we have a low, we have a higher high, we have a, and it just continues. It keeps going, it keeps going. Now, the reason why I'm showing you guys this thing on the live chat is because it's not always going to be as smooth and perfect as it is when I'm showing you guys this thing with lines and stuff. You know, like look at this thing. Look at how it looks. This is an uptrend. It's still an uptrend, but look at how it looks. It looks so messy. That's how it is. So that's what you're going to be facing in the real life market. That's why it's very, very important to use life examples when explaining stuff. So you see it in practicality, like you see it really happening, right? Now, looking at this, we've really dissected this. This is an uptrend. So where is the impulse and where is the pullback? So like I said, impulse is the movement in direction of the price, right? This is impulse. You can see how powerful it is. Then this is a pullback, a very, very tiny one. You can also consider this a consolidation though, but it's still a pullback. Look at when the market is about to push back in its original direction. Look at the force. You feel me? Then when it's come back, it's struggling. Then it started rallying back, accumulated price. Then it distributed. You see how it's pushing, right? This is impulse. Impulsive moves. The moves upwards are always stronger because it's an uptrend. You can see even this one here. This is an uptrend. So you want to be buying in an uptrend, right? Now let's look at an example of consolidation. Now this is an example. This is a very good example of consolidation. As you can see it, we have lows, equal lows, we have equal highs. That's the definition of our consolidating market: equal lows and equal highs, right? So you can see here price is bouncing. You can still put another one here. You can see how price is just bouncing up and down, right? This is this is a nightmare for traders, especially support and resistance traders. They just think like a support and resistance trader actually think is like the best, market condition where they can just trade back and forth, bouncing here and there. You have a bunch of trades, but you lose margins on them. All right. So yeah, this is a consolidating market, but it's not the best market condition to trade in. And this is an example of a downtrend. All right. Now, looking at this, you can clearly see it's a downtrend. All right. You can see the trend line sloping downwards. You can also see the prices here changing because why? Price has left from point A up there down to point B, which is a decrease in price. So price has dropped. The market is trending down. Okay. Now, let's break this chart down. Now, look at this. We have a high, we have a lower low, we have lower high, a lower low, lower high, lower low, a lower high, an internal low, internal high, internal low, internal high, and a lower low, lower high, just like that, So at one point the market will consolidate, at one point the market will break structure to the downside, but the main push or the impulse is going low. The impulse is driving to the downside. That's why this trend is a downtrend, because majority of it is impulsing to the downside, right? Even though we have internal consolidations, sometimes we have deep pullbacks that we think it's actually the market is reversing, but the market is not reversing. If you look at this pattern that I've drawn here with this line, you can see that the biggest moves we have here is going down, right? We have consolidation, but the biggest moves is downwards. Okay, so this is a downtrend, and in this kind of market condition, we want to be selling. You don't want to buy in this condition. You want to sell. Why? Because the majority of the volume is driving towards the downside. Okay, now we have that out of the way. Let's move on to the next concept. Okay, guys, so here we are on the second concept of this video. All right, so today in this concept, we'll be talking about efficiency and inefficiency. Now, there are two different charts on my screen right now. If you look at it, the one on the left is efficient and the one on the right is inefficient. Now, what difference can you spot between these two? Now, it is very clear. If you look at this one very well, this one is efficient. In other words, it's proper. When I say proper, I mean because price fills every gap on its way up. You feel me? Like the price is trending upwards. Every fair value gap or imbalance that's been left behind has been filled. It has been tapped into, right? Let's draw it like this. Let's say this is an imbalance right here. It has been tapped into. Let's say this is another imbalance right here. Another imbalance right here. It has been tapped into. This other imbalance right here has been tapped into, right? Now, these are all levels that the price will leave on its way up. On these price legs, when the price is expanding to the upside or is impulsing to the upside, it always leaves gaps. Why? Because sometimes it moves too quick that it does not fill these gaps immediately, but it fills them in a shorter period of time, or sometimes it takes longer to fill these gaps. But my strategy, or this strategy that we are trading, is to emphasize on trading the shorter time period, where these gaps have been filled. Like if the gap is formed, we should focus on it being filled immediately, not on the ones that get filled later. You feel me? So if the gap has not been filled, or if it does not get filled immediately, or at least a few moments, or after it's been created, then we don't want to trade that level again. You understand? So this is an efficient price chart right here on the left. All right, with pink, this pink, this is the efficient. Because why? There's no reason for price to come back here. Everything has really been fixed. Everything's clear. It is a proper price chart. This is a price chart. It should look. On the other hand, this is inefficient, which means price has left behind footprints. It has left behind, signs that it's coming back. You understand? It's coming back to do the finish touchings. You feel me? So you cannot just, go based off of, this price chart here is incomplete. It's inefficient. Why? Because there's an imbalance here. If you look at it here, you see that this whole candlestick here is empty. These lines represent candlesticks, okay? So this whole price level here is very, very inefficient. Why? Because the prices on this side has not elapsed with the prices on this side. The wicks have not touched, nothing. There's a huge gap here. If you know what imbalance is, you understand what I'm saying. So this price chart is inefficient. What we want to do now as traders is to come here and put our levels to trade from. We can trade out like this, then we wait for price to come back and tap into it, like so. When price comes back to tap into it, then we trade back up. This is an efficient price chart. All right. So as long as this gap stays open, it is inefficient. Beautiful. Now let us move to real chart examples. Okay, guys. So this is a real life example of an efficient price chart. Okay. So this price chart right in front of you guys here is efficient. When I say this price chart, I mean this area. Let me box this area up. I want you to keep your eyes locked in this area, in this box right here. Okay. Now let me clear that out for proper vision. And let me zoom in a little more so you guys can follow along. All right. Now let me show you guys why I said this is efficient here. Now we have price moving. We have price breaking structures and coming down. If you look at it here, we have a low, we have a high, we have an internal low here, we have an internal high, then we have a break of structure. This high here has put out the new low that has broken the previous low, setting us down in a downtrend, right? So price has broken this area. When price breaks a structure to the downside, what we want to do is look for sells, right? So now that we have this, the next step is to identify our fair value gap. Is there a fair value gap on this prices on this level? Yes, there is. Now let's look at it. Let's do this. Now that we've identified our fair value gap, where is it? This is our fair value gap right here. If you look in between this candle here, this big candle, there's a fair value gap on it. You can see the gap, right? This wick and this wick did not touch each other. It left a space in the middle. This is called inefficiency. All right. So, but the second price came back to fill it. It's now efficient. So the opposite of inefficiency is efficiency. All right. So it was inefficient for a moment. Then maybe a couple of hours later, it was now efficient. So this is now an efficient price chart. But at one point, it was inefficient because of the gap. When the gap has been filled, it is now efficient. So looking at this price here, this particular price movement, I'm sorry about that. This particular price movement, there's no reason for us to trade here again. There's nothing here to trade unless you are trading another strategy. But if you're trading this strategy, there's nothing here to trade. Why? Because the gaps have been filled. We're trading gaps, remember. All right. Now, this has been filled. Let's look at the next price leg. The next price leg is this one. We have a low, we have a lower high. We have a breakout structure to the downside. Do we have a gap? Yes, we have a gap. This is it. This is our gap right here. Is it efficient or inefficient? Like I said, at one point it was inefficient, but at one point it was efficient when price filled it. So right now, all this area here is inefficient. It's efficient, sorry, because I've been filled. It's a proper price chart. Let's continue. Let's look further. All right. We have price moving, we have structure, we have another lower high here, then we have a little consolidation and a break of structure to the downside eventually, leaving us with what? This gap. There's a gap here. You guys should pay attention. There's a gap here. There's a gap right here. All right, let me delete that. So this is the gap. We have a wick, a candle there, and this other wick right here that did not touch each other. If I draw that out, let's label this fair value gap. Beautiful. You can see the fair value gap and you can see the nice touch right there. Okay, so now let's assume that we're trading this live. When the price was inefficient, we traded it until it was efficient. We would have had one trade here, which is a winning trade. Then this trade here would have probably been a losing trade. These are things that we cannot control. I'm not teaching you guys here how to take 100% winning trades. I'm teaching you guys how to trade with fair value gaps, with high probability of winning your trade. Okay, so you're going to have losers. The majority of your trades will be winners if you trade exactly the way I teach you. All right. Now we've had a winning trade here. Let's draw this out. This is looking at this. Let's say we enter here. Stop loss sits on top of that candle. This is what I preach in all my videos. If you watch my previous videos, All right. Then we have a 1 to 2 risk to reward. We have 2% right there on that trade. Then we follow up and take another trade here, just right here. And this one stops us out. I've lost 1% because we risk 1% to make 2%, right? Yeah, we lost 1% right there. Then we come furthermore and we trade here again. All right. Another entry. Very, very nice entry. I like this one. I really like this one. There's some kind of liquidity build up here, which is a perfect setup. Then we have a stop loss just on top of the candle that the favorite gap resides on. Then we have a 162 right there. You can go for more. It depends on you. I don't have the balls to do that. So I'd rather just stick to my 162. It's perfect for me. All right. You can do what works for you. All right. Now, every time you see a fair value gap, you have to make sure that it aligns with the break of structure. Don't just go and trade in fair value gap. The break of structure is to tell you the direction in which you are trading. You feel me? If it breaks lower, you are selling. If it breaks high, then you are buying. So that's why break of structure is very, very important. Don't just see these lines as fancy. It's not fancy. You look at it and it tells you a story. It tells you what's going on. You feel me? Yeah, this is everything that's going on. So the 3 trades that I've taken, these are the structures that they broke before I took them. These are the structures right here that they broke before we took them. Break of structure here, we traded. Break of structure here, we traded. Break of structure here, we traded. So overall, we took 3 trades and we lost 1. We are up. How many percent? We are up. I think it's 3% because we're supposed to be 4% because we lost here, so it's 3%, right? So that's our net. Beautiful. So this is an example of an inefficient and efficient price chart. I think I've explained both of them here. So I'll see you guys on the next concept. Okay, guys. Sorry about that. I had a glitch. My internet connection had a problem, so it kind of disrupted and it scattered everything. I think this is the second time I'm recording this video. Anyways, let's continue where we stopped. So like I was saying, in this particular trade example in front of us, let's see how we can manage this trade. Like I said, there's many ways to manage this trade. It depends on the strategy that works for you. All right. But to be honest, sometimes when you're like in a losing streak, you manage your trades differently. You're scared, you're worried because your account is really, really down, and you just feel like every single trade is just coming to, drain the life out of your account every single time. So when you're in a trade and it just starts showing profit, you just want to take it because you're trying to build up your account back. These things are real. All right, let's talk about it. Let's not just ignore it and act as if we are just better than everybody, or you don't experience these things. Why? No, it's everything. Everybody faces these things. I do face these problems. All right. So what I'm saying is, what we can do about this is, you have to stay disciplined. Like, if you're losing your accounts, you just have to, accept it, because that's exactly what you knew was going to happen the second you put money in that account. Deep down, you knew there's a higher chance you're going to lose it. But you still took the chance because why? You're a fighter. Like, you believe that you can actually win this thing. But at the same time, you don't ignore the fact that you can blow it up. So when it's about blowing up, just keep to your rules. Try to make sure that you're in the proper mind state. If you feel like you're stressed, don't trade. When you're ready to trade, take those trades and you hold them. Hold those trades. Why? Because trades like this will mess with your mind. Look at this one. Just imagine sitting in this trade, and it came out here, it activated your order, right? Instead of dropping another huge 2-hour, this is opposite direction inside your trade. And then look at this one. The next candle came out and still went up to this level, almost taking you out of this trade. You can imagine how red your account will look. Then within an instant, so within a blink of an eye, boom, it dropped all the way to almost 1 hour in profit. And then when you're about to relax and stuff or chill, it still pulls back again in drawdown. That's trading for us. This is real. In drawdown again, now you're in drawdown, you're sweating and everything, and then eventually drops, comes out again, still goes up, then eventually now collapses to your TP. That's a 2-hour trade right there. After all the emotional roller coaster, the stress and everything, you ended up winning. So this is the advantages of holding your trade. Always hold your trade. So the way to manage your trade is take the trade and sit and do nothing. When it's red, close your computer or your phone, turn it off, distract yourself, talk to somebody or go somewhere, I don't know, just do something. Do not touch the trade. Allow it. Like this one. Allow it to go. Allow it to go. You understand? Let it go. Give it a chance to lose. Give it a chance to win. Here too, same thing. It tagged you in. It pushed up a little. Then eventually dropped. Some trades will be like this. They won't stress you at all. You feel me? This trade here is less than 2 hours. Less than 3 hours of your time. This trade will be done. And you've made your money already. You feel me? And it's a beautiful setup. Very, very beautiful setup. And I like the way it played out. Very beautiful. If every trade was like this, you won't have problems. So that's just what I wanted to tell you guys. Just an advice, guys. Take your trades, hold them. Don't break even. Don't I don't know. I will not tell you guys to not break even. You can break even sometimes. When the trade moves like, let's say 1 to 1.5, you can break even. Of course, you can do that. But what I'm saying is, don't close your positions early. Don't forget about all of that. Hold your trades to the end. So with that out of the way, guys, this is it for today. This video was actually patched up because my computer kept messing up and I had to re-record everything back again. So I still try to put out content for you guys. I started dropping content back to back. We started 2 days ago. I have 2 videos up. This is the third one. You guys should show me support, show me love, like this thing, comment, share this thing, to encourage me to keep going. So I'll keep bringing you guys valuable content every day. So be sure to subscribe, turn on your notification bell so you don't miss any content from me. I'm dropping here every single day, back to back. I'll see you guys on the next one.